How did Andy Fastow create complex Enron financial schemes? Imagine a company that looks like it's thriving, but behind the scenes, it's hiding a lot of problems. That's what Andy Fastow did at Enron. As the company's chief financial officer, he built a web of complicated financial tricks to make Enron seem more successful than it really was. Fastow used special legal entities called special purpose entities, or SPAs. These were separate companies created just to hold certain assets and liabilities. By transferring risky assets or debt to these SPAs, Enron could keep those problems off its main financial statements. This made the company look like it was earning more money and had less debt than it actually did. One of the main tricks Fastow used involved setting up partnerships called the LJM partnerships and the Raptors. These entities were controlled by Fastow or his close associates. Enron would sell assets to these SPAs at a high price, then buy them back later at a lower price. This fake sale boosted Enron's earnings temporarily. Fastow also used financial options called put options on Enron stock. These options were supposed to protect Enron from stock price drops but were actually used to hide losses. When the SPAs lost value, Enron paid large sums to buy them out, which was not clearly reported. This kept the true financial state hidden from investors. Fastow personally profited from these deals. He owned stakes in the SPAs, which created conflicts of interest. For example, in a deal called the Southampton transaction, Enron bought an entity controlled by Fastow for $30 million. This deal benefited him directly, even though it was not in the best interest of Enron. He also manipulated earnings and cash flow. By moving debt off the books and recording fake revenue, Enron's financial reports looked strong. This tricked investors into thinking the company was doing much better than it really was. Fastow's schemes relied heavily on hiding details. The transactions between Enron and the SPAs were not properly disclosed. The risks and guarantees involved were kept secret, preventing anyone from seeing the real financial risks. He worked closely with banks that helped create and carry out these complex transactions. These banks designed financial tools that allowed Enron to manipulate its reports, often earning big fees and benefits in the process. In the end, Fastow's web of off-balance sheet entities and fake transactions made Enron look healthy on paper. But when the truth came out, the company collapsed. His actions show how creative accounting and financial engineering can distort reality, leading to major economic disruptions. This scandal led to new laws and rules to improve transparency and prevent similar frauds in the future.